Good morning, dear student. I am Kunal Kiran from the Millennium School, Lucknow. Children, we have been discussing about the accounting treatment at the time of admission of a new partner. Till then, we have discussed about goodwill treatment, about reserves and surplus, about revaluation of assets and liabilities. And yesterday I have started capital adjustment treatment. And in this capital adjustment, there are two ways of adjusting the capital of the partner. One is adjustment of old partner's capital on the basis of new partner's capital, and another is calculating the capital of the new partner on the basis of capitals of the old partners. So, case 1 we have sufficiently discussed yesterday. Today I would like to discuss with you the case 2, that is calculating the capital of the new partner on the basis of capitals of the old partners. Children, in such questions, new partner's capital is not given, although in the question they give you information that new partner is bringing capital, but the amount is not mentioned. They usually use the language that new partner will bring proportionate capital according to his own share, right? So when such question asked, and when that situation comes, then what the steps you will take to find out the required capital or proportionate capital of the new partner, what he is supposed to bring. So first of all, determine total adjusted capital of the old partners. So after all adjustment related to goodwill, reserves and surplus, revaluation of assets and liabilities. So you go as you usually do for the goodwill treatment, reserves and surplus, revaluation of assets and liabilities. After doing all adjustment, you calculate the balance of the old partners. After getting their balances, next step to determine the total capital of the new firm on the basis of old partners' combined capital. For that, the formula is total adjusted capital of the old partners, or combined adjusted capital of the old partner, multiplied by reciprocal of combined new share of the old partners. Suppose A is coming for 1/4 share, then definitely the old partner's new share will be 3/4, right? So you will calculate the total capital of the new firm on the basis of total adjusted capital of the old partners. So the formula is total capital of the new firm equal total adjusted capital of the old partners multiplied by reciprocal of combined new share of old partners. So after getting this total capital of the new firm, you directly calculate the incoming or new partners required or proportionate capital. So new partners capital equal total capital of the new firm multiplied by new partners share of profit. To understand this, I have given you one example. Suppose A and B are partners. C is coming for 1/4 share and he will bring proportionate capital as per share. So new profit sharing ratio they have decided, old ratio was 2:1 and new ratio they have decided 1:2:1. And adjusted capital, after all adjusted capital means after making all adjustment. So adjusted capital of A is 80,000 and B is 1,60,000. Now my concentration is here to explain you how to calculate the proportionate capital of the C. So first of all, we will calculate combined adjusted capital of the old partners, that is 80,000 plus 1,60,000, it is 2,40,000. combined new share of old partners. So A is having 1 by 4 share and B is having 2 by 4, that become 3 by 4. Or you directly get it, C is coming for 1/4 share, so remaining share is 1 minus 1, 1 minus 1 by 4, that is the old partner's new share, 3 by 4 combined share. So any of the way you can calculate the combined new share of the old partners. Now calculate the total capital of the new firm on the basis of combined capital of the old partners. Total combined adjusted capital of old partners multiplied by reciprocal of combined new share of old partners. So rupees 2,40,000 multiplied by they are having combined share 3 by 4 and reciprocal is 4 by 3. So total capital of the new firm is 3,20,000. Now, on the basis of this, we can directly calculate the new partner's proportionate capital. So, total capital multiplied by new partner's share of profit, that is 1 by 4. So, he has to bring 80,000, right? And the journal entry for this, cash or bank account debited to C's capital account. Now I'm going to take one full length question comprehensively. A and B are partners in a firm sharing profit and losses in the ratio of 3:1. They admit C for 1/4 share on 31st March 2014 when their balance sheet was as follows. On the liability sides, there are 4 items: employees provident fund, workmen compensation reserve, investment fluctuation reserve, and capital balances. On the asset side, stock, debtors, less provision, investment, cash, and goodwill. The following adjustments were agreed upon. C bring in 16,000. The first one, C bring in 16,000 as a goodwill and proportionate capital. Now see, they have written proportionate capital but not given what is the amount he is bringing. That you have to calculate. Now second adjustment, bad debt amounted rupees 3,000, means debtor is involved. Market value of investment is 4,500. Again, investment is involved, as well as this will be considered in IFF will be considered. Liability on account of workmen compensation reserve amounted rupees 2,000. So workmen compensation is involved. We will take one by one. Prepare revaluation account and partners capital account. But we will prepare balance sheet also, as well as we also going to pass necessary journal entries, because in the board's examination both way can be asked. They can ask pass necessary journal entries and prepare by balance sheet, and another way they can ask prepare revaluation account, partners capital account, and balance sheet. And sometime if the question is not the long way, they can ask for 4 marks or 6 marks. They can ask in this way, prepare revaluation account and partners capital account. So I would like to cover it comprehensively. So first of all, A and B having a old ratio of 3:1 and C is coming for 1/4 share. C is bringing 16,000 as a goodwill. So for that, the journal entry will be cash account debited to premium for goodwill account 16,000, and this premium for goodwill will be credited to old partners in their sacrificing ratio, because nothing is mentioned in the question about how the old partners have sacrificed in favor of C. So their old ratio will be the sacrificing ratio. So premium for goodwill account debited 16,000 to A's capital to B's capital in the sacrificing ratio, and sacrificing ratio is 3:1. So this you will show it in your ledger. So in the ledger, buy premium for goodwill, in A's column 12,000 and in B's column 4,000, right? Apart from this, cash will be increased Cash is having balance of 6,000, 6,100, 16,000 will be added, and we will also add when we calculate his proportionate capital. So I'm not concentrating about the cash, although I have shown here cash earlier it was 6,100, add 16,000, right? Now I'm taking one by one. So employees provident fund, we have a knowledge that employees provident fund is a liability for the business. They are not the surplus reserves for the business, so they are treated as a normal liability. Nothing is, no adjustment related to employees provident fund is given in the question. So employees provident fund rupees 17,000 will be shown in the balance sheet as it is. This I have shown here in the new balance sheet of the firm. Now next is workmen compensation reserve 6,000, and the D1 liability on account of workmen compensation reserve amounted to rupees 2,000. So actual liability is 2,000 and we have a reserve of rupees 6,000. So balance of rupees 4,000 will be distributed among the old partners in their old ratio. So the journal entry is given here. Workmen compensation reserve 6,000. 2,000 we will transfer for creating a liability for workmen compensation claim 2,000, and rest of 4,000 will be credited to a old partners in their old ratio, that is 3:1. Now this liability will be shown in the balance sheet and capitals will be credited with 3,000 and 1,000. So I am showing you how they have shown. This is, they have shown 3,000 and 1,000, and in the balance sheet workmen compensation claim will be shown as 2,000. I hope you would have understood. Now next is investment fluctuation fund. In investment fluctuation reserve is given 4,100. So investment fluctuation reserve has been given 4,100, and the adjustment says market value of investment is 4,500 and book value of investment is 7,000. Book value of investment is 7,000, this one. So in market investment value is 4,500, but in the books the book value of investment is 7,000. So difference is the fall in the price of the investment in the market. So this fall in the price of the investment will be set off against this set off against this investment fluctuation reserve. So 7,000 minus 4,500, so the difference is 2,500, right? So 2,500, there is a fall in the price of investment is 2,500. So we have a investment fluctuation reserve 4,100. So out of this 4,100, 2,500 will be utilized for meeting out the loss due to fall in the price of the investment, and rest of amount, that is 1,600 amount, will be distributed among the old partners in their old ratio. So the journal entry is investment fluctuation reserve account 4,100, investment is decreased by 2,500, and remaining 1,600 will be shared by A and B, that is old partners in their old ratio 3:1, that is 1,200 and 400. Now in the balance sheet you will show the investment at its market price, that is 4,500, and the same time you also make a adjustment in the capital by writing by investment fluctuation reserve. In A's column you will write 1200 and B's column 400, right? So this adjustment has been completed. Now the next amount is given partners capital balances, so you will brought down 54,000 and 35,000. Now next is uh, stock. There is no change in the value of a stock. There is no adjustment related to a stock. There is no adjustment related to a stock. So stock will be shown in the balance sheet as it is, 15,000, right? Now next is about debtors. Debtors has been given 50,000 and provision for doubtful debt is 2,000. And there is an adjustment B part. Bad debts amounted rupees 3,000. So there is a bad debt of 3,000. So debtor is decreased by 3,000, and this loss due to bad debt can be recovered by using this provision. We are having a provision of 2,000. So 3,000 out of 3,000 which can be set off against this provision, we are having only 2,000. So 1,000 will become the actual loss. I will show you through the journal entry. So provision for doubtful debtor is decreased by 3,000, and provision for doubtful debt is utilized to meeting out the bad debt is 2,000, and revaluation account, that is 1,000 actual loss. Actually this is a combined journal entry. We can have two journal entries. I have shown you on yesterday's question. So first journal entry, you can pass bad debts account debited, bad debts account debited to debtors account 3,000. Then that bad debts will be written off against provision for doubtful debt. So we have a bad debts of 3,000. So provision for doubtful debt will be utilized 2,000, and 1,000 which is cannot be recovered, that become loss. So revaluation account will be utilized for meeting the loss. So revaluation account will be debited to bad debt. So instead of passing two journal entries, because bad debt once in first entry bad debt is debited and in second entry bad debt is credited. So combinedly this is the combined entry, and you can pass it. You have this is the combined entry, and you will sundry debtor in the balance sheet. Sundry debtor you will decrease by 3,000, and provision is having a 2,000 balance earlier in the balance sheet. Now it become over because now provision for doubtful debt is debited. So provision, there is no need to show the provision because it is already written off, and the same time revaluation account will be debited with the amount of 1,000 only. So this is shown to sundry debtors 1,000, and in the balance sheet debtors have been shown 47,000. Earlier it was 50,000, 3,000 deducted as a bad debt. No provision has been shown. Now next is investment. We have done cash, we are doing goodwill. Now existing goodwill should be written off. Existing goodwill should be written off among the partners in their old ratio. So this is given 3:1, 40,000, and it will not, goodwill will not be shown in new balance sheet because goodwill is written off. Now this is the loss on revaluation because debit side 1,000, credit side is nil. So this loss will be transferred to A and B's capital in their old ratio, and the journal entry will be A's capital account, B's capital account debited to revaluation account. Now next is calculation. We have transferred a revaluation account and we have already done everything. So now we calculate the balances. A is having a balance of 39,450 and B is having a balance of 30,150. On the basis of these amount, we will calculate. So combined capital of the old partners is 69,600, and this is because C is coming for 1/4 share. So combined share of the new old partner, combined new share of old partner is 3/4. So 3/4. So total capital of the firm is combined capital multiplied by reciprocal of or combined old share. So 92,800 will be the total capital of the new firm, and C share is 92,800 multiplied by 1/4, that is 23,200, and he will bring it by cash 23,200, right? And the journal entry will be cash account debited to C's capital account. So you will, this balance will be shown in the balance sheet, and cash, he is bringing 23,200 cash, so the total cash become 45,300. Both the sides are equal. If you go through, sum up all the items, 1,11,800.